All right, so we need to discuss at least a little bit more specifically the impact that using each of these different cost flow methods will have on actual financial statements. Okay, and we have four of them here, four differences. Three of these are income statement items, and then of course we have inventory. I think I may have mentioned this before, that do recognize that in the rare, extremely rare situations where prices remain the same, all three methods are going to yield the same results. But if that was a realistic possibility, we could just go on our merry way and not have to worry about it, and that wouldn't be any kind of fun at all. So here we have a situation that is based upon the numbers that we've looked at in previous videos. You remember, hopefully, we had the situation where we had that was product 127B was the name of the product actually, and we said that we had beginning inventory of 1,000 units, and then we had purchased 500 more during the month, and then we purchased 600 right at the end of the month, giving us goods available for sale of 2,100 units. And we also said that ending inventory was 800 units. So when we look at this slide here and it says using the perpetual inventory system illustration with sales of 39,000, this 1,300 units that we're talking about is the 2,100 units available for sale minus the 800 that we still have in ending inventory. Okay. And then the sales price on those just happens to be $30, okay? And so these methods are going to produce different results. Now these numbers, I'm trying to think here if these numbers match up exactly, because I believe when we looked at these the last time, we were looking at a periodic inventory system. So notice our sales are going to be the same. Now, cost of goods sold for first in, first out is going to be the same whether we're talking about a perpetual inventory system or a periodic system. So I know for a fact that this number is correct. But what it looks like we're dealing with here, yeah, I know this number is a lot lower because we were at 29,000 something under the periodic system. But do notice what we're looking at here is we're looking at a situation where prices have gone up slightly. So cost of goods sold is lowest for first in, first out, and highest for LIFO, and then kind of right in the middle for cost of goods sold. That means because cost of goods sold is less under FIFO, gross profit and ultimately net income will be highest under FIFO and lowest under LIFO, again with weighted average in between. Okay, well, if our cost of goods sold is lowest under FIFO, ending inventory will be the highest under FIFO and lowest under LIFO. Again, one more time with weighted average coming in right in the middle. Okay, so effects of changing costs or prices for our inventory, LIFO and FIFO cost methods. This is a slide that if you have the ability to screenshot this, print it off, I would certainly recommend that you do that, okay? Because it has been my experience that oftentimes students can perform the calculations. They can organize their thoughts and they can perform the calculations. The math is not that difficult with inventory. But the conceptual ideas of how you push this, what do you pull? And that's what we're dealing with on this slide. So in periods of increasing prices, what happens? Well, if prices are increasing, cost of goods sold is going to be highest under LIFO because we're costing those most recent purchases which are increasing. But notice here, over on decreasing costs, it's the exact opposite. If prices are decreasing, FIFO will produce the highest cost of goods sold because under LIFO we're costing all of those recent purchases that are at lower prices. Okay, so go through these, look at them, and memorizing this stuff is not going to help you very much at all. But if you can understand the reason why each of these things is true, both for increasing costs and decreasing costs, then you can understand everything in this chapter. Because again, the math is not going to be that difficult. I will say this. If you had to master either this column or this column, I would probably tell you to master this column. Most college level textbooks deal with periods of increasing costs because that's what we see in the real world for the most part, right? Every once in a while prices go down, but for the most part prices go up. But if you can get both of these columns down, then you've just about got the chapter whipped. All right, so it says here, FIFO reports higher gross profit and net income than LIFO when prices are increasing. Why? Because our sales price is assumed to be the same. You know, in our example, it was $30, right? So FIFO is going to be costing those older items first in, first out. So if prices are going up, the items that we're expensing under FIFO are less expensive than under LIFO. Okay? It says, however, in periods of rapidly rising costs, the inventory that is sold must be replaced at increasingly higher costs. So essentially this gross profit and net income, enjoy it while you can because it's not going to last forever. And we may have a period of time where we have what are called inventory or illusory profits because we're getting the temporary timing benefit of being able to cost old merchandise that we paid a lot less for, and then so that can create a problem in the next period because we wonder, okay, well, why is it that we're selling the same amount of stuff but we're not making nearly as much money? Well, it's for this reason right here. It says during a period of increasing costs, LIFO matches more recent costs against sales on the income statement. And for that same reason, LIFO also offers an income tax savings during period of increasing costs. If prices go down, it offers an income tax disadvantage. Okay, so one thing I will tell you, your textbook, and I really don't care what textbook you're using, your textbook probably says something about FIFO being the better method, you know, one way or other. In fact, LIFO is not even allowed under international financial reporting standards. I think the truth is that LIFO does a better job with the income statement because it matches recent costs against sales, which are definitely recent. But it does a poor job with the balance sheet because on the balance sheet we have that, if again, assuming a period of increasing costs, the balance sheet under LIFO is going to be made up of those older costs that do not reflect current wholesale prices. Okay, so FIFO has a balance sheet advantage, LIFO has a bit of an income statement advantage. Now we also want to talk about in this discussion of inventory the impact of errors. Remember, we said no matter what, whether we're using a periodic inventory system or a perpetual inventory system, we have to make a physical inventory count at year end to kind of reconcile and figure out what the true statement is as it pertains to inventory. So we have some examples of some mistakes that can be made. It says physical inventory on hand was miscounted. Now hopefully, now this is obviously a much bigger problem with a periodic inventory system because with that type of system, we're not tracking it except for the physical inventory on hand. So that's a really big problem with periodic inventory. Costs were incorrectly assigned to inventory. Think about two items that are coded similarly, but they have a vast difference in price and in sales volume. So we can end up with a massive inventory problem that way. Inventory in transit was incorrectly included or excluded from inventory. This is going back to our discussion. Remember FOB, shipping point, FOB, destination. So this is only a problem if we talk about annual financial statements. This is only a problem at the very, very end of the year, but it can still be a problem. And then finally, consigned inventory was incorrectly included or excluded. What we're talking about here, consigned inventory, that just means that the store that we find this merchandise, the owner of that store does not own the inventory. So give you a really good example of that. Sometimes when you, if you've ever gone into a convenience store, you might find a display of souvenirs for whatever state that you're in, you know. And there's a strong possibility that the owner of that convenience store does not own those souvenirs because they're probably a very slow seller and they don't want to invest that money into that inventory. But they will allow a consignor, person who owns that souvenir inventory, to put that in there, and then it's coded in their POS system, their point of sale system, so that whenever one of those items sells, one of those souvenir items sells, they can recognize that, hey, we owe this guy this money, and then the consignor will come in and hopefully none of the stuff gets shoplifted, and we can work it out. But if the owner of that convenience store counts that merchandise in inventory, well, that's a problem. And at the same time, if the owner of the merchandise does not count it, just because it's not in his physical possession, well, that's also a problem. Okay, so this is kind of a minor thing, but it is an issue that we have to deal with when it comes to inventory. All right. It says inventory errors often arise from merchandise that is in transit at year end. This is what we talked about, FOB shipping point, FOB destination. So not to spend too much time on this slide, but think about this from the perspective of the buyer. They make a purchase on, say, December the 29th, which is not going to arrive until, say, January the 3rd. Well, if it's FOB shipping point, the fact that they have title to the goods, not physical possession, they're supposed to count it. At the same time, the seller of the goods in this case would not count it. And then FOB destination, this is usually a problem that impacts the seller of the inventory. They ship it on the December the 30th or 29th. It's not going to arrive until January the 3rd. And because it's gone, the seller doesn't count it. Well, that seller would still have title until January the 3rd, and so therefore the seller could make a mistake with inventory. And then we have the example of consigned inventory. Got some terminology here. The consignor is the individual who actually owns it, and the consignee is the person who is trying to sell the merchandise. Another example I just thought of, I see these little stores that sell high-end clothing, usually women's clothing, I think. And so the consignor, there are actually multiple consignors. And then the consignee is actually the shop itself. But think about a situation, especially in that kind of an environment, where maybe 50-60% of your merchandise is from multiple just individuals, right? And then 40-50% of your merchandise is owned by the store. It can get confusing, and we can end up with some inventory mistakes. All right, so We have a little slide here. This is another very good slide. It's a conceptual slide. You need to understand why this is the way it is. We do have a handout video that is available on this topic, but we need to understand, if beginning inventory is understated, that's going to cause cost of goods sold to be understated, and that's going to cause both gross profit and net income to be overstated. Again, I do encourage you, I believe it's a matching exercise, but I do go into some detail to explain that. If you have, I would print this slide off or screenshot it, and if you have problems understanding the why this is the case, you should in fact reach out to me. So that previous slide was dealing with cost of goods sold, gross profit, net income. Those are all income statement items. We also have a similar slide that you should be able to understand that deals with inventory, but look at this. It talks about current assets, total assets. Now, whatever the impact is on inventory, it's going to be the same over here. And then we're even bringing in stockholders' equity into the equation. So another very good slide. Make sure you understand why these errors have the impact that they have, or when you get on a test, you're going to have problems. All right, finally we have one last Checkup Corner exercise. You can find this in your ebook or you can screenshot it. Here is, and I don't normally do this to you, where we, in an introductory level class, where we cover 2 years here, but they're wanting to know what is the net effect of the error for the 2 years. And then we have the solution here. So you can make a screenshot of that or find that in your textbook. All right, that's it for Chapter 6 on inventories.